In the spring of 1986, a young trader sat alone in his office on the 56th floor of a Manhattan skyscraper, watching 3 computer screens flicker with numbers that represented billions of dollars moving through global markets. His name was Ivan Boesky, and at that moment he was perhaps the most successful arbitrage trader Wall Street had ever seen. He was also about to become the most hated man in American finance. But this hatred didn't emerge from a single catastrophic trade or a market crash he caused. It came from something far more corrosive to the fabric of trading itself. It came from betrayal. To understand how one man could become synonymous with everything wrong about trading in the 1980s, we must first travel back to a different era entirely, to the early years of the 20th century, when the very concept of market integrity was still being defined. Wall Street in 1900 was a place of whispers and handshakes. Trading happened in crowded rooms where men shouted orders and scribbled on paper. Information moved slowly, through telegrams and telephone calls, through conversations in private clubs and over expensive dinners. The stock market wasn't the regulated machine we know today. It was closer to a frontier town where fortunes could be made or lost based on who you knew and what you heard before everyone else. In this world, insider trading wasn't just common, it was expected. The very idea that all investors should have access to the same information at the same time would have seemed absurd to the financiers of that era. Trading was about advantage, and advantage came from connections. If you sat on a company's board, you used that knowledge to trade. If you heard a rumor about a merger, you acted on it. This was simply how the game was played. But as markets grew larger and more Americans began investing their savings in stocks, something shifted. The crash of 1929 and the Great Depression that followed revealed the dark side of this unregulated approach to trading. Millions of ordinary people lost everything, while insiders had quietly sold their positions weeks or months before the collapse. The public outrage was immense. In response, Congress passed the Securities Exchange Act of 1934, creating the Securities and Exchange Commission, and for the first time, making certain forms of insider trading illegal. The new law established that markets needed to operate on fairness, that trading based on material non-public information gave some investors an unfair advantage that undermined confidence in the entire system. Yet laws on paper don't immediately change culture. For decades after 1934, insider trading remained widespread on Wall Street, whispered about in private but rarely prosecuted. The SEC was understaffed and underfunded, proving that someone traded on inside information was extraordinarily difficult. The culture of advantage, of using connections and privileged knowledge, persisted beneath a thin veneer of regulation. This was the world Ivan Boesky entered in the 1960s. Born in Detroit to Russian immigrant parents who ran a network of bars, Boesky seemed driven by an insatiable hunger for wealth and status. He attended law school but never practiced law. Instead, he gravitated toward trading, specifically toward risk arbitrage, a strategy that involved buying and selling stocks of companies involved in mergers and acquisitions. Risk arbitrage, in theory, was perfectly legal. When Company A announced it would acquire Company B at a certain price, arbitrageurs would buy Company B's stock and wait for the merger to close, profiting from the difference between the purchase price and the announced deal price. The risk came from the possibility that the deal might fall through. Skilled arbitrageurs studied merger agreements, analyzed regulatory hurdles, and made calculated bets on which deals would succeed. Boesky claimed to be a master of this craft. Throughout the 1970s and early 1980s, he built a reputation for uncanny accuracy. His trading firm generated extraordinary returns year after year. Other traders marveled at his success rate. He seemed to know which mergers would succeed and which would fail before anyone else did. By the mid-1980s, Boesky had become a legend. He managed hundreds of millions of dollars. He owned a sprawling estate in Westchester County. He donated money to universities and cultural institutions. In 1985, he published a book called Merger Mania about arbitrage trading, and he was invited to give the commencement address at the University of California, Berkeley's business school. At that commencement, Boesky delivered a line that would become infamous. "Greed is all right, by the way," he told the graduates. "I think greed is healthy. You can be greedy and still feel good about yourself." The audience applauded. This was the 1980s, after all, an era when trading had become glamorized in popular culture, when young people flocked to Wall Street dreaming of Ferraris and penthouse apartments. Boesky's words seemed to capture the spirit of the age: ambition, success, winning. But beneath this gleaming surface, something rotten was festering. In reality, Boesky's extraordinary success in trading had nothing to do with superior analysis or calculated risk-taking. He was cheating. For years, he had been paying other Wall Street insiders for confidential information about upcoming mergers and acquisitions. Before these deals were announced to the public, Boesky would quietly accumulate massive positions in the target company's stocks. When the deals were announced and stock prices jumped, he would sell for enormous profits. One of his key sources was Dennis Levine, a managing director at the investment bank Drexel Burnham Lambert. Levine had access to information about dozens of major corporate deals. He would tip off Boesky, who would trade on the information, and the two would split the profits through an elaborate system of offshore accounts. Another crucial source was Martin Siegel, a top investment banker at Kidder Peabody. Siegel provided Boesky with details about mergers his firm was advising on, receiving cash payments delivered in briefcases. For years, this network operated in the shadows. The trading was too clever, too dispersed across multiple accounts and jurisdictions for regulators to detect the pattern. Boesky and his conspirators believed they were untouchable. They were wrong. In May 1986, the Securities and Exchange Commission arrested Dennis Levine. Bank records from Switzerland and the Bahamas revealed suspicious trading patterns. Under interrogation, Levine began to cooperate with investigators. He gave them a name, Ivan Boesky. The SEC investigators could hardly believe it. Boesky was one of the most prominent figures on Wall Street. But as they dug deeper, following the trail of offshore accounts and coded phone calls, the scope of the conspiracy became clear. Boesky hadn't just occasionally traded on inside information. He had built his entire trading operation around it. Nearly every major position he'd taken in the past 5 years had been based on illegal tips. In November 1986, the SEC announced that Boesky had agreed to plead guilty to insider trading charges. He would pay $100 million in penalties and disgorgement of profits. He would serve time in prison, and crucially, he would cooperate with prosecutors in their investigation of others. The news sent shockwaves through Wall Street. Boesky wasn't just successful. He had been held up as a model, an example of what smart trading could achieve. Business schools studied his strategies. Young traders tried to emulate his approach. Now it was revealed that it had all been a fraud. But the real earthquake was still coming. Because Boesky knew everyone, he had connections throughout the investment banking world, at law firms, at trading desks, inside corporate boardrooms. And now, facing prison, he was willing to tell prosecutors everything. Over the next several months, Boesky wore a wire. He recorded conversations with other traders and bankers. He provided detailed records of payments and trades. He became the government's star witness in what would become the largest securities fraud investigation in history. One by one, the titans of 1980s Wall Street fell. Martin Siegel at Kidder Peabody pleaded guilty and cooperated. Michael Milken, the junk bond king at Drexel Burnham Lambert, was indicted. Dozens of traders, lawyers, and investment bankers were charged. Some went to prison. Others paid massive fines. Careers were destroyed. Firms collapsed. The man who had embodied the success of trading in the 1980s had become the architect of its greatest scandal. And for this, Wall Street hated him not just because he had cheated, but because he had betrayed them. There's a particular code that operates in criminal conspiracies. Loyalty matters. You don't cooperate with authorities. You don't give up your associates to save yourself. Boesky violated this code completely. He gave prosecutors everyone he could, provided every detail he remembered, handed over every document he possessed. Other white-collar criminals had cooperated with investigators before, but rarely someone so prominent with so many connections, who could implicate so many powerful people. Boesky's cooperation unraveled an entire network. He had been at the center of it, and now he was tearing it apart from within. When Boesky finally entered prison in 1988, he was reviled by both the public and his former colleagues. To ordinary Americans, he represented the excess and corruption of Wall Street, the insider trading on a massive scale while regular people played by the rules. To the Wall Street community, he was something worse, a traitor who had broken the fundamental rule of never informing on your partners. He served just 2 years in prison, a relatively light sentence in exchange for his cooperation. When he was released, he largely vanished from public life. He divorced his wife, who had been a source of much of his initial capital. He moved to California. He gave no interviews. The man who had once courted publicity now avoided it completely. The scandals Boesky's cooperation revealed fundamentally changed trading in America. Congress passed new laws strengthening insider trading penalties. The SEC dramatically expanded its enforcement division. Investment banks implemented strict compliance procedures. The freewheeling culture of the 1980s, where traders operated on tips and connections, gave way to a more cautious, regulated environment. But the story's deeper significance lies not in the regulatory changes, but in what it reveals about human nature and markets. Boesky's rise and fall illustrates a pattern that repeats throughout trading history. The temptation to cheat, to gain an edge through illicit means, proves irresistible to some people, no matter the era or the consequences. Every generation of traders faces this temptation in different forms. In the 1900s, it was railroad stock manipulation and bucket shops. In the 1920s, it was pool operations and pump and dump schemes. In the 1980s, it was insider trading networks. In later years, it would be accounting fraud, Ponzi schemes, market manipulation through new technologies. The specifics change, but the underlying psychology remains constant. Some traders believe the rules don't apply to them. They convince themselves that everyone else is cheating too, so they're simply leveling the playing field. They focus on the potential rewards and discount the risks of getting caught. They surround themselves with people who enable and encourage their behavior. Boesky fit this pattern perfectly. Despite his law degree, despite the clear illegality of his actions, despite the fact that he was already wealthy beyond most people's dreams, he continued to trade on inside information year after year. The greed he celebrated in his Berkeley speech wasn't healthy ambition, it was pathological. What makes his story particularly tragic is that he possessed genuine skill as a trader. Many market observers believe that if Boesky had operated legally, he still would have been successful. Risk arbitrage is a legitimate trading strategy that requires intelligence, analytical ability, and nerve. Boesky had all of these qualities, but they weren't enough for him. He wanted the certainty that illegal information provided. He wanted to eliminate risk entirely. This is perhaps the ultimate irony. Trading, by its very nature, involves risk and uncertainty. That's what makes it trading rather than theft. The arbitrageur accepts the risk that a merger might collapse. The stock picker accepts the risk that their analysis might be wrong. The market maker accepts the risk that prices might move against them. Risk is not a bug in the system, it's the essential feature. Boesky tried to remove risk through cheating, and in doing so, he betrayed the fundamental nature of trading itself. He turned what should have been a test of judgment and analysis into a rigged game. And when the game was revealed as rigged, the public's faith in markets was damaged, perhaps irrevocably for some. Today, when new traders enter the markets, they inherit the legacy of Ivan Boesky whether they know his name or not. The regulations they navigate, the compliance procedures they follow, the surveillance systems that monitor their trades, all of these emerged in part from the scandals he helped expose. The culture of Wall Street, more cautious and more aware of legal boundaries than it was in the 1980s, was shaped by his downfall. But his legacy extends beyond regulation. His story serves as a reminder that in trading as in life, character matters. The decisions we make when no one is watching, the temptations we resist or succumb to, the people we choose to become, these things have consequences that ripple far beyond our individual circumstances. Boesky made his choices. He chose illegal shortcuts over honest effort. He chose betrayal over loyalty. He chose greed over integrity. And in the end, he achieved his goal of becoming one of the most famous traders in Wall Street history. But the fame he achieved was not the kind any trader would want. He became the man everyone pointed to as an example of what not to be, the cautionary tale, the symbol of corruption, the most hated trader on Wall Street. There's a final twist to consider. In his cooperation with prosecutors, in his betrayal of his co-conspirators, Boesky arguably did more good for the integrity of markets than his years of illegal trading did harm. His testimony helped clean up Wall Street, expose systemic corruption, and led to reforms that protected future investors. Does this redeem him in some small way? Most would say no. The circumstances of his cooperation, the fact that he informed only to reduce his own sentence, the reality that he would have continued cheating indefinitely if he hadn't been caught, these facts overshadow any positive outcome. Yet history is complex. The most hated trader on Wall Street became, inadvertently, one of the most important whistleblowers in financial history. Not because he wanted to be, but because he had no other choice. His legacy is not just one of greed and corruption, but also of the consequences that eventually find those who believe themselves above the rules. The markets continue on, as they always do. Traders still pursue profits. Regulations still try to enforce fairness. And somewhere in the background of every transaction, there's a reminder that markets are ultimately built on trust. Trust that the game isn't rigged. Trust that information is shared fairly. Trust that everyone faces the same risks and opportunities. Ivan Boesky broke that trust. And in breaking it, he revealed how precious and fragile it really is. That might be the most important lesson his story offers. In trading, as in all human endeavors, trust once lost is nearly impossible to fully regain. The hatred directed at Boesky wasn't really about the money he made illegally, or even about the people he betrayed. It was about the trust he violated, the fundamental compact between markets and society that he shattered for his own gain. And that is why, decades after his crimes, his name remains synonymous with everything wrong about trading, when it loses its connection to fairness, integrity, and honest competition.